It was supposed to be a tax cut for manufacturers. Then it got out of control. World Wrestling Entertainment took it for producing wrestling videos. Regional gas stations claimed it because they mix ethanol with base fuel. Grocery stores asked for it because they spray their fruit so that it ripens. Pharmacists could take it because they have booths that print photos. Republicans in Congress passed that deduction more than a decade ago, and they repealed it in the tax bill signed on Friday by President Trump. It is a lesson in the abundant creativity of American business in interpreting the tax code. The latest overhaul could play out the same way. Already, lawyers and accountants are eyeing several provisions that investors and companies could potentially exploit. The bill, for example, lowers the taxes on so-called pass-through income, which is earned by partnerships and other types of businesses. Congress sold the provision as a way to help smaller companies. But lawmakers added language that allowed big real estate developers to benefit. The result could be a tax break for any company that buys and operates a building for its business. The new law is also supposed to encourage companies to make investments in the United States. But the rules were written in such a way that they could give businesses an incentive to keep their money in foreign countries and build factories abroad. The wildly popular manufacturing break, passed in 2004, is a case study in the unforeseen consequences of changing the tax code, how companies take advantage of gaping holes and force the government to play catch-up. The provision, known as the Domestic Production Activities Deduction, gave companies a tax break on income they earned from making things in the United States. It was intended to help American manufacturers, which were struggling to hold their own against competition from overseas. Then a raft of other industries heard about the rule as it was being devised and fired up their lobbying machines. Suddenly, everyone became a manufacturer. Movie studios got the break because they produced films, and tech giants won it, too, for making computer software. Construction companies got it for making buildings, and so did engineers and architects for designing them. Starbucks hired lobbyists to make the case that it, too, was a producer, because the company roasts coffee beans. Congress added language that allowed coffee shops to deduct a percentage of every cup sold if it was made with beans they roasted off-site. It became known as the Starbucks footnote. This has been a boondoggle tax expenditure, said Robert J. Shapiro, a former Commerce Department official who founded the economic advisory firm SOECO. It is a political lesson. You are always liable to create tax loopholes that grow. The government initially estimated that the 2004 law would cost a net $27.3 billion from 2005 through 2014. It ended up costing over $90 billion during that period, according to a congressional report. The Internal Revenue Service had to warn retailers that cutting keys doesn't make you a manufacturer. Neither does mixing paint, putting plants in the sun to grow, or writing happy birthday on a cake you didn't bake.